Federal Reserve kept rates on hold yesterday as expected, but our next guest is saying that is a big mistake. He once again, well, I don't know if you're always the only member, Don, but definitely yesterday, the only member of our mock Fed to vote for a rate cut, and he wanted 50, a half-point cut as well. Don Peebles is here on set with us. He's chairman and CEO of the Peebles Corporation. Welcome.
Thank you.
You know, people get, but Don, you're a real estate developer. Of course you want lower interest rates. Give us the broad economic rationale.
The broad economic rationale is high interest rates have created tremendous stress in local and regional banks. Local and regional banks are the primary lenders to small businesses, and they're not making loans anymore. And what has happened is that the local lenders are stressed because of the large portfolio of commercial real estate that they own and apartment buildings. And they are generally the development lenders or the bridge lenders for commercial office buildings.
But let me stop you there and put my populist hat on and say, I don't care. Why do I care what happens to the banks, right? What about everybody else? I don't know.
Well, we do care about the banks because they're fueling the economy, and small businesses create the vast majority of the jobs in this country, and local and regional banks are the primary lenders to those industries. And then, of course, the housing market. We have a housing shortage in every major city in the country. There's a significant shortage, rental housing and for sale housing. And what's happening now is housing affordability has been the lowest that it's ever been since they've been keeping statistics. So most Americans cannot afford to buy a home, and they have to spend a disproportionate amount of their income to pay for one. All driven by interest rates.
This is very complicated, and so it's tough to do right here. In his interview yesterday with Scott Wapner, great interview as normal, Jeff Gundlach said something fascinating, which was that in parts of the commercial loan market, they're starting to re-rate some of these big loans that we were talking about, retranche them because of higher rates or whatever. It's a very complicated story. But what I heard, I think, Jeff say was that bubbling under the surface, way deep, but starting to bubble, are bigger problems in commercial real estate because of rates than we may think. What do you think about that?
Absolutely. I think there's been this attitude with most lenders, including in the CMBS market, the special servicers, is to give these buildings a little bit more breathing room in terms of making debt service payments and the like, with the hope that interest rates would decline. That now is a far-gone conclusion that they won't decline anytime in the foreseeable future. And so, therefore, you've got significant stress in that sector. And also, what was an A tranche is no longer an A tranche. Because
what is it? So that's what I think Jeff Gundlach got to. But when you say tranche, your mind goes back to 2006, 2007. In sort of plain-ish English, what does that mean when they say re-rate, retranche?
Well, basically, it's simple. If you have a loan and you look at it as a stack, a pyramid here, or a building block, the top building block is the A tranche, and that would be the premier tranche.
Super credit, no risk of default,
et cetera. And it's a small portion of the loan. Maybe it's the top 10%. So, and then you have here at the bottom the worst portion, the highest risk, the loss first. So if a loan's $100 million and you have the D tranche, if you will, and that tranche is $10 million, then that's the first loss. So if the loan goes down to, or the property declines in value from $100 million to $50 million, then there's a $50 million loss there. So that works its way up the different tranches. And what's happening is getting dangerously close to the mid-level, to the upper portion of the tranches that are supposed to be risk-free. And as a result, those are going to have to get repriced for investors because the risk is greater. Otherwise, they can't trade them.
Right. But is that why people in that space are going to say, we'd love lower interest rates? Give us some breathing room, right? What about people who say, but inflation, that it's going to be persistent, it's going to be sticky. If we lower rates here, that we're never going to conquer or vanquish it?
But the hidden inflation is what Americans spend the vast majority of their money on. They spend it on housing and automobiles. Those are the top two purchases. Both are interest rate sensitive. And without attractive interest rates, they can't afford to buy either one. And what happens when they buy fewer homes and fewer cars, then jobs are lost. And so there's a double impact there. And what you're seeing now in many sectors now are job cuts are beginning to take place now. And more are going to start happening. And and they're going to be in banking, they're going to be in real estate, they're going to be in construction. And, and unless we see a change in policy, I think we could be dangerously close to a recession.
Can the Fed change that policy? Because the Fed cut rates last year and the bond market went in the completely different direction, basically thumbing its nose, at least for now, at the Fed.
Well, I think the bond market didn't take the Fed seriously. They were tiny
That's a problem, Don. What you just said is a massive statement, I think.
Yeah, but the reality is that the Fed should have made bigger cuts. They should have been 50 basis points at a minimum every time. And there should have been at least a 100 basis point cut in that process. And now to make these minimal cuts and then to do nothing and look all around you, every sector that's affected by interest rates has gotten worse.